So, you're in the market to purchase some real estate. Whether it's going to be your own home, a rental property, or a flip, you might be overwhelmed by all the different kinds of loans available to you. Today, I'll teach you about some of the most common mortgages you'll find in the market today and help you make an educated decision on which one is right for you. So there's many different kinds of loans, but the 5 most common are conventional, FHA, VA, USDA, and owner finance. Which is the right one for you? Let's get into it. Conventional loans typically require a 20% down payment, which is a significant amount of money, locking many people out of a mortgage for years. Conventional loans tend to have a lower monthly payment because of the lower purchase price since your down payment was so high, and putting 20% down or more exempts you from needing PMI, or private mortgage insurance. This is a type of insurance that protects the bank in case you default or foreclose on the home, allowing the bank to recuperate some of the money still owed from a third party. Conventional loans will also offer lower interest rates if you have very good or excellent credit, as opposed to most government-backed loans. They are available in 10, 15, or 30-year mortgages and tend to allow higher loan limits, or how much money you borrow, since you're putting a significant amount of money down. The loan approval and closing will also be much faster, since the loan is not being overlooked by the government. For example, when I closed on my property using an FHA, it took 45 days, as opposed to a conventional loan, which would have took closer to 20 days. Conventional loans are also preferred by the seller since there's less risk involved, as once you're pre-qualified, the deal is less likely to fall through, like on a government-backed loan. You'll usually need a score of 640 or above to qualify for a conventional loan, and a DTI, or debt-to-income ratio, of 43%. Your DTI is how much debt you have versus your income. This is used so banks can calculate how much of a risk you are and see if you can actually afford the home. If your scores aren't quite there where they need to be, click the link in the description below. Conventional loans also allow an unlimited amount of units if you're buying multifamily or apartments, as opposed to most government loans, only allowing 1 to 4 units. However, anything above 5 units will be considered commercial property and will usually require higher down payments, anywhere between 25 to 30% range. Commercial property can also include other kinds of real estate, like storefronts and office buildings, which will not be available for purchase with most government-backed loans. The FHA loan, or Federal Housing Administration loan, is a government-backed loan with a minimum down payment of 3.5%, as opposed to the usual 20% of a conventional. This means that on a home that's worth $400K, instead of putting down $80,000, you put closer to $14,000 down, leaving significantly more money in your pocket. This loan is confused as being a first-time homebuyer loan, and even though you can be a first-time buyer to access it, you don't have to be. As long as you use it as a primary residence and live in it, or in one of the units, you can access this loan, regardless if already owning another home or not.